All right, let's get right into it. There's a huge financial shift that's predicted to happen, and I mean very soon. We need to talk about what this could mean for your money. So it all kind of kicked off with this one statement. It's from a top Fed official, John Williams, and honestly, it flew right under the radar for most people. He said, and I quote, "The Federal Reserve will soon need to grow its balance sheet again." Now, this wasn't just him thinking out loud. No. This was a signal, a major heads up that a big change is on the horizon. I know. Growing the balance sheet. It sounds like some super technical jargon meant to make your eyes glaze over. So let's just cut to the chase and translate what that really means for all of us. Yep, you guessed it. The money printers are firing back up. A fresh wave of cash is about to get pumped into the financial system. And the timeline for this? We could be looking at this kicking off as soon as 2026. And look, this isn't just some wild guess. We've got what looks like a pretty clear timeline of events that are already in motion. You see, this has been a coordinated message. You had Fed Chair Jay Powell hinting at it back in October, and then other officials started singing the same tune. The path seems laid out. Quantitative tightening, or QT, is scheduled to wrap up this year, and by the first quarter of 2026, Wall Street is already penciling in the Fed buying up to $50 billion in assets every single month. So how in the world did we get here? To really get what's happening, you have to understand the two massive levers the Fed pulls to mess with the money supply, QE and QT. Okay, so think of it like this. It's actually pretty simple. You've got two main tools in the Fed's toolbox. First, there's QE, or quantitative easing. That's the gas pedal. The Fed starts buying up stuff like government bonds, and boom, they're pumping cash right into the economy to get things moving. Then you've got the opposite, QT, or quantitative tightening. That's the brakes. They stop buying, maybe even sell some assets, and that pulls money out of the system. Why? To cool things down and fight inflation. Gas pedal, brake pedal. Simple as that. So, if the Fed's been slamming on the brakes for years, why on earth are they getting ready to hit the gas again? It's a great question, right? Because the economy isn't exactly falling off a cliff. The real reason isn't about goosing the economy. It's much more of a behind-the-scenes technical issue. And it gives us a fascinating look at how the whole financial system actually works. So remember, for the last 3 years, the Fed's been in QT mode, hitting those brakes. They've taken their balance sheet from a mind-boggling $9 trillion all the way down to $6.6 trillion. That is a ton of money that's been sucked out of the system to fight all that inflation we saw after the pandemic. But here is the catch. If they drain too much, the whole system can just break. The banking system is kind of like the plumbing in your house. It needs a certain amount of water, in this case financial reserves, just to work properly. If the water level gets too low, the pipes seize up, the money markets freeze, and suddenly you have a real crisis on your hands. This isn't theoretical. It actually happened back in 2019. The Fed is desperately trying to make sure it doesn't happen again. Okay, but here's the real kicker. The reason they're doing this might be technical, but the result for the markets could be absolutely explosive. Turning those money taps back on, even just a little, can have massive consequences. Big thinkers like Ray Dalio are looking at this and seeing a pretty dangerous cocktail being mixed. We already have sky-high stock prices, huge government deficits, and inflation that just won't quit. Now, we're about to pour new money printing into that mix and maybe get a new, more easy money Fed chair? Well, that's the recipe for what's called a melt-up. That's a crazy, final, blow-off-top surge in prices right before a nasty crash. Dalio's take is that the Fed is basically pouring gasoline on a fire, stimulating an economy that's already in a bubble. All this new liquidity could just push asset prices up to insane, unsustainable levels. His advice? You might be able to ride that wave up, but you better be ready to get out before it all comes crashing down. Okay, so knowing this might be coming is one thing, but what do you actually do about it as an investor? How do you prepare? Let's walk through 4 practical tips. First, and this is key, follow the money. Follow the liquidity, not the confusing news headlines. The market is going to react to the cash, period. Second, please don't chase the top. Smart investors build their positions during the dips, not when everyone is euphoric and buying like crazy. Third, spread your bets around. When there's this much money flooding the system, a rising tide can lift a lot of boats, stocks, crypto, precious metals, you name it. And finally, and I can't stress this enough, be so careful with debt. Let's really hammer this last point home, because using borrowed money or margin is a trap that can absolutely destroy you, even if you're right about where the market is headed.
So imagine you've got $100,000 to invest, but you get greedy, you use margin, and you buy $300,000 worth of assets. As the market goes up, you're feeling like a genius, right? But here's the thing. Markets never go up in a straight line. Never. Even in the biggest bull markets, a 33% correction can happen. It's totally normal. Now, if you didn't have any debt, that 33% dip would hurt, but you'd recover. But for you, with your leveraged position, a 33% drop on $300,000 is a $100,000 loss. Your entire initial investment, gone. Poof, you're completely wiped out, with nothing left to even catch the bounce back.
And this really gets to the heart of the problem. These cycles of stimulus, they keep getting bigger. Every crisis seems to require an even larger bailout than the one before it. It's like the system is an addict that needs a bigger and bigger dose just to keep going. And we all know how that story usually ends.
Look, this isn't just some academic exercise. This is a cycle that we see over and over, and it has very real consequences for your wallet. A new tidal wave of liquidity heading for the market. So the only question left to ask is, are you prepared for the ride?